Hi everyone. Thank you for joining us for another event of IEEE at Home blockchain series. In this case, also supported by the WP9 capacity building from the Nubis project. Today we'll be talking or having a talk about tokenization of real-world assets, redefining the future of finance. This talk will be led by Edwin Mata. He's a CEO and co-founder at Brickken, a pioneering platform in the tokenization of real-world assets. He's a qualified lawyer and entrepreneur by vocation. Edwin brings together, we just changed the page, together his legal and technological expertise to drive the global adoption of blockchain-based solutions, and his vision centers on democratizing access to financial markets through regulated, efficient digital instruments. He will explore how tokenization is transforming the way financial assets are created, managed, and traded, sharing Bricken's experience in converting equity, debt, and property into liquid, traceable digital assets that comply with international regulations, and will highlight the role of blockchain technology in enabling innovative business models and how organizations can access global capital more transparently and efficiently. I would say that this talk will be about 50 to 60 minutes. Edwin, you can do it as you want. If you want to do it interactively, you can do it interactively with participants, or you can have Q&A in the end. It's up to you. So it's the way you see better for you. It's okay by us. I will leave the chat open, so if people have any comments or questions, you can, during the presentation, leave the questions on the chat. And if Edwin allows me, and once I check there is any kind of question related to what he's saying, I will interrupt him and ask him if he could answer the question, so maybe if he's okay with it.
Yeah, of course.
So let me just thank Edwin once again for taking this invitation. We still have more participants, and I think people will still be joining us, but we cannot wait any longer. So Edwin, I would say the stage is yours. Feel free to start your presentations, and anything that you need, just tell us.
Okay, so I think everybody can listen to me. So I'm just going to share my screen. Let's do like a 20-minute introduction as to what is tokenization, and from there we go into Q&A to make it more interactive. Okay, so before I begin into explaining what is tokenization, I like to start because obviously we're into the blockchain. There's the word token in the tokenization word, so there's a lot of right now establishment as in what is regulated, what is not, what is legal, and what is not legal. So I think that's kind of like always a pain point to understand that if you enter these side of things, the Web3, the crypto, however you want to blockchain, however you want to call it, there's a degree of uncertainty, or I would like to say of marketing uncertainty. Because one thing is what the people say, and one thing is what the legality says. And sometimes we fall short to understanding that maybe companies or specific entities, even governments, try to push a narrative that is not necessarily entirely true, right? So what I'm saying here is by default, in all jurisdictions across the globe, because this is kind of like comes with the Roman law, and we can go to the initiations of how regulations came to be, but there's a absolute must, and I don't know the word in English, but this is kind of like this is a rule that influences all jurisdictions and all legislations absolutely on everything. All right, so I'm giving you the maximum of legality here, and then I'll start digesting as to why I'm emphasizing so much on this, what I'm trying to explain. By default, every single action that a natural person or a legal person can do, there's a legislation that it's applicable to. All right. So whenever we perform any kind of business or action from a personal side of thing or a business side of thing, there is something a legislation that it's applied to. So sometimes we understand that we go through a business model and people say like, oh, there's not a legislation for that. That is an absolute lie, right? Because in legislation, there are some things called simile, analogy, case law. So that means what is not at a specific time is a specialization, right? So we have to understand that throughout the journey of us with the technology and legislation, it is true that legislation goes a lot more slower and technology advances at a pace that humans themselves, when they legislate and come together to put in together a framework, it's way slower. But the reality is that even though it's a slow, there is always something that it's applied to. So in 2011, 2017, with the whole blockchain applications and everything, there was a lot of people saying that there's no legislation covering that. That is an absolute lie. Because, for example, in 2017, with the whole initial coin offerings, there were people saying, it looks like a security. So some governmental bodies try to apply securities law to how that work. Then others try to apply corporate law. The thing that happened with blockchain was that since its innovation was too abroad and too digitized for the common of whatever we were doing, then there was not a specialization. So specialization comes, for example, general data protection regulation, things covering how companies manage our data. That didn't came to be since data came existent. That came to be as a necessity. Then the framework specializing as to how companies should regulate data came to existence, right? So that's an specialization. It happens everything. It happens when new companies get incorporated and they need to oversee, kind of like companies or humans have changed. We need to specialize and regulate this different. So what I'm trying here to establish is that everything related to blockchain, crypto, Web3, AI, there's something that is always applied to. No matter what you guys think that it's, or even space law, there's always something that it's applied to. So the thing is that everything is regulated. There's no such thing as unregulated. The only thing that matters is that maybe at the theme or concrete subject that we currently have at hand, there's not a specialized law. A specialized law by default right now in whole European Union is MiCA. So MiCA is a specialization, so there's no more uncertainty as to how it has to be regulated, the Web3 crypto utility stablecoins world, because before that, it was a very great area to understand what law should be applied to the thing at hand, right? So I'm sorry for the 5-minute boring thing about being a lawyer, just trying to give you some legal certainty, not my thing, not going to be a research report right now, just giving you why this is super important, all right? Because from here, if we understand that everything has a regulation, but maybe not a specialization, that is where innovation thrives. Because if we were thinking that there's nothing applied, it would become illegal. And people don't like to do illegal things. Maybe some people do. But this is not the case of what we have at hand, all right? So if we understand that now Web3 is completely legal because it was always legal. The problem was there was not a specialized law. Now we do understand that there's three big nucleus on the blockchain side of things, right? Tokenization thrives on the green circle, but at the framework of things, there are utility tokens, which is the cryptocurrencies that everybody understands by. Is Bitcoin a utility token? Bitcoin is still a utility token because you need Bitcoin to use the Bitcoin network. You need to pay in Bitcoin to use the Bitcoin blockchain. So it is still a utility, but it is true that it is now mutating into a reserve for value. But this is the journey of Bitcoin itself. Ethereum. Is Ethereum a utility token? Yes, because you need Ethereum to pay the gas fee to execute things on Ethereum network. So even cryptocurrencies that they named them cryptocurrencies were never a currency. It was a currency because it was easy to digest and marketing wise to expose to the markets, but they were always utility. And this is what happens now with MiCA. MiCA decided to take away the currency word. Maybe in a couple of years, cryptocurrencies will cease to exist. And now we see a lot of people talking about utility tokens. So it is true that now we have a word to understand that they were never a currency. Currencies in this world exist by default. They are just the legal tender currencies in the world. So the euro, the USD, the yen, wherever we want to go. Those are legal tender currencies, and those are the only legal framework of currency that central banks execute. And maybe in the foreseeable future, they're going to go with central bank digital currencies and all the innovation that is driving. But the important thing is, at the Web3 blockchain world, no currencies are being invented or being used. They are either utility, even though Bitcoin and Ethereum, so people call them like the currency or proof of reserve, they are still under the framework of a utility. And then we have the next one, the stables. The stable coins actually were first admitted under MiCA. Now we have even the Digital Act in the United States where they're talking about stable coins. Stable coins became by de facto their own circle, right? So stable coins, it is actually tokenization, and I'll explain why it is a tokenization. But the important thing is that stable coins are a one-to-one pair to something else. To something else means a legal tender money. So to the USD, then we have USDC, USDT, and a bunch of other ones. We have EuroC in Europe. So the company Circle created a stable coin that is backed by the euro coin. So stable coins, right? It's the only one that is always backed by legal tender money. We have other ones falling in between utility and stables and security, which is asset-backed reference, but that's a very niche type of thing. I'm not going to go a lot into detail of that, because the main three circles are either what you issue on the blockchain, it's a utility token, or it's a stable coin, or it falls fully into a security, right? And we're not talking about security of the internet or anything. We're talking about securities as equity, debt, bonds, financial instruments. Every single jurisdiction out there has a bunch of securities, and they're bounded by the security laws. For example, how do we know that the specialization happened? Because MiCA, being a specialized law for the Web3 world blockchain for utility and stablecoins, in its first article, it establishes that it does not regulate securities. So that's why I came at the beginning. Since the beginning, there was a lot of information about, kind of like a utility is a security. Ethereum during 2018, it was considered by some a security because whatever. So the important thing is, when the specialization happened, MiCA decided to say, we need a specific framework for utility and stable coins, but I'm not going to touch securities, because securities have always been existent. There have been securities law for hundreds of years in many countries. So that didn't need a specialization. What it happened with securities laws, and it's still happening, like in every single legislation out there, there's currently been an upgrade. So for example, in various countries in Europe, the upgrade is that now the word distributed ledger technology is being included in some articles. So it's not that the securities law is being fully renovated, it's that it's being upgraded to the tendency of the new technologies. And that is happening in other countries, not just in Europe, but they're saying, you know what? Securities are changing by the current state of technology, that we have to put inside this already used framework the correct form for the innovation to thrive, right? So again, just establishing that there's not a single thing out there that there's not a regulation being applied to. It's just that either you specialize or you upgrade and modernize what you have. So by default, in reality, right now, we have three solid niches in the Web3. And I'm not talking about the NFTs, there's other things, but even an NFT falls into a utility or a security. If we talk about the other things about the metaverse, it falls the same. This is the three big niches in Web3, and the rest are sub niches under that species. So either you have a security, either you have a utility, or you have a stable coin, right? So these are the three main frameworks. Now, my specialization lies in the security side of things, and we're going to talk about it. So what is tokenization? We go to the next slide. Okay. So tokenization is, tokenization means representing something in reality. A token is a representation of something else. We use tokens for a lot of things that we don't even know we're using a token. So one of the easiest examples is it's a debit card from your bank account. A debit card is a token that gives you access to you use your money that you have deposited in the bank account, and they give you this the representation of your balance, which is a token, right? So with that token, you can go and pay things in various things with an ATM or with a payment card or whatever. But the important thing is that's a token. People don't understand it because we just use debit cards and we call it debit cards, but in reality, it's a token because there's technology embedded that allows you to use the currencies that you have in your bank account and start paying things with that. All right. So super simple to establish that we in reality use a bunch of tokens out there. If you want to go offline, poker chips are tokens because when you go to a casino, you exchange your dollars. Let's say we're in Las Vegas, you change your dollars, and the casino gives you a representation of your dollars, so you can play internally. That's a token. All right. So what does it mean for tokens in Web3? When we say tokenization, is that means that we are representing same way of the card chip or the debit card or the poker chip that we are. Susana, can you mute yourself because can if you guys are not asking, can you please mute, because if not there's noise and I don't know if you're gonna ask something. I can mute, by the way. All right, so thank you very much. I'm sorry for that, but because if not, it was a lot of noise. All right. But if you want to have a question, by all means, you have the chat and you can raise your question and you can say, Edwin, I have a question. No problem there. All right. So when we talk about tokenization, is we are representing something on this new technology, all right, on the blockchain, the distributed ledger technology. And what are we representing? In reality, when we talk about tokenization, is we're representing most likely financial instruments. Financial instruments, what are the best bet known? Equity, bonds, debt. Those by default are the biggest financial instruments. There are other hybrid instruments, convertible notes, according to the debt, the maturity length. There's a lot of different financial instruments that we use, or they're very specialized and very niche. But by the biggest ones by default are either equity or debt. Everybody uses debt. When you go to the bank account, with your bank, and you order a mortgage, the mortgage is it's debt because you are asking for a loan. So that is debt. When you create your company, whatever you are, they're giving you equity. So that's equity. It's a financial instrument. Those things have always been used, right? So I mean, since centuries ago, there exist the financial instruments. The important thing is that they have been digitized, right? So we went from paper format to paper signatures between two people who met in a specific place and exchanged signatures to decide a contract for that agreement to be in place. Then we can talk about the internet, that we have electronic signatures, so I can send you an email agreement, and then we can comply as to how that issues happens. Even banks now use telematic, whereas they send you through an email the loan agreement, which you kindly accept via DocuSign or whatever, and you are part of the agreement, to what we have right now, which is kind of like the new variant. But it's not that we are revolutionizing, it's just the nature of evolution of technology is leading us to using this new framework, right? So blockchain technology. So what we're doing is evading all the paperwork, the in-persons, or the limitations of the geographic to settle financial instruments, and I'll go on top of that, to a worldwide situation that is available, right? And here I want to do some clearance as to why I'm saying that. By default, the blockchain is just one huge ledger, right? What is a ledger? Accountants use a ledger book, an Excel sheet, where they establish what are the transactions, they put what happens, who pays, and all of different information that it's available only to them in a closed book. But it is a ledger. Companies use ledgers on a daily basis. Now, what happens with the blockchain? Imagine now that that ledger is fully available to anybody from any point in the world at all times in a situation 24/7. We have this huge ledger that every single transaction that happens gets put on that. That opens the world in the sense that why would you embed financial instruments on that? It's just because that information being available can establish more efficiencies. For example, how does it work when you loan to the let's do Nasdaq, even Nasdaq. Okay, Nasdaq is the biggest financial market where all the IPOs of the biggest companies hold, and is the most liquid market. We will think that it's a 24/7 market, but it's not. It closes, and even the settlements don't happen instantaneous. It happens through a broker. There's technology that still it's owned by some persons or entities that are regulated, but it allows the market to flow and work. But everything is not happening truly in real time. All right, because even though we are at the highest point of technology, the internet and all of that, certain things, just because the information is owned by entities, doesn't allow it to be in real time. It's instantaneous, and now we're talking about seconds away from real instantaneous flows, but it's not happening because the databases are not open between them. They're not sharing the data, they're not sharing a lot of things. So that means that there's still latencies, and that's slowness into the market. Now, if you take away all these intermediaries and everybody has access to the same information of huge databases, that means that in reality, everything can be instantaneous. And this is why stable coins are thriving, because just another example that doesn't have to do with tokenization, but is very close and related to. When you do a bank transfer, the settlement is not instantaneous. Even though you send the money, you don't send the money per se. There are reference points between the banks that they acknowledge that the money is about to be sent and received, and maybe they update you before the money is even received. There is a lot of huge discrepancies because in the middle there's a SWIFT payment, the intermediary doing the transactions between the banks. All right. So why is now a lot of companies doing stablecoins? Because you take away the SWIFT payment and you transact in this purely open ledger that when you send the transaction to one entity, the other receives it in real time. There's no coming back from that. And that is why stablecoins are thriving currently. And we see PayPal launching their own stablecoins. We are seeing kind of like Robinhood saying they're going to maybe launch. Even banks, Bank Santander in Spain is about to launch a stablecoin. And why are they doing this? It's because the information is open 24/7. The settlement is instantaneous, happening in real time, and there's no intermediaries. Remember that intermediaries in every transactions slows and not days fees, right? Don't matter in what sector you are, an intermediary is what it is. It's a slowness to the process between two ends. So the less intermediaries is, the less friction and the more natural, less fees will happen. So this is what's happened with the stablecoins. You're taking away the SWIFT layer, which is the biggest provider between banks, and there's other ones, of course. But I'm saying with that, and you're making it naturally instantaneous. So the stablecoin technology or the settlement, how it happens, can be applied to financial instruments. But there's a lot of other things. And I'm going to say why tokenization matters a lot and why now a lot of jurisdictions are updating this. And it has to do with uh, the fact that when you want to raise capital, you usually are constrained to your geographic section. In Europe, it is true that you can send a bank transfer to Germany, and if you use the SEPA payment, it should be without fees, okay? Because it's a European Union, the state market, or whatever. The problem lies when you want to receive money abroad, and now even UK. Let's put it to the next most proximate country. When they left the European Union, they started charging fees because they were not part of the unitary monetary system, and they decided to do their own thing. So when you send money to even a used to be company, the European company, country in the European Union, now you have to pay fees, and this is two fees. Okay, and then we can get more complex because it does matter from what country you are sending money. For example, if you send money right now to Thailand, you are gonna pay a lot of fees, and we can talk about that. But even UK, that is next to where I am currently right now, and I suppose a lot of you because we are in from this webinar. When you buy the UK pound, you buy the UK pound at the highest value interday because the banks will always sell you with a profit margin. So if they buy the pound, let's say I'm going to do something completely stupid because it's not the true value right now. I don't know. But let's say at €2, they will sell it to you at 250 because when they buy all the UK pounds, they have to make profit of this. So they know that. So it's kind of like when you want to send money, the bank tells you, hey, do you want me to buy the UK pound for you to send it over there? Or you want the pound to be exchanged at the destination bank? Either one, whatever you're sending, you already lose money. Secondly is the SWIFT. They charge you a fee for sending to bank. If not in the European Union and not in SEPA, you will not be sending without fees. So between banks, there's two possibilities. Is both fees are paid by both parties. You can do that. It's paid by the sender or the receiver. The important thing is your 100 euros that were supposed to land 100 euros in the UK will never be 100 to 100. It will always be less fees and the amount of loss because you bought UK pounds to the bank itself. So when you do capitalization, mostly it happens in your geographic section. And this is why kind of like when you buy or promoters of real estate, which is a clear example, when they start raising capital, they only use it across if German to Germans. And it's not because they don't want to globalize, it's just because when they have to receive money elsewhere, they have to return higher APY or they have to figure out how to return the money lost on the sending. Because if they're raising 10,000 capital, let's say 10,000 from a Colombian person, the Colombian entity will have to understand how much money is being lost on the transaction. So if I'm sending $10,000 or 10,000 euros in this case, and I'm losing 7%, and you're returning me 12% APY, that means it will take me almost a year just to return the investment that I made to you because of the fees. So I would not invest. It's too much of a risk for me to just make 5% on a year to understand that the fees are going to come back to me in the form of payment. And this is why capitalization only happens in the same geographic region. So now let's fall back to the stablecoin situation or the open layer. What happens is if you tokenize and use the technology of blockchain, the 10,000 euros that the Colombian entity wanted to invest in the German can be done. So the Colombian German entity sends 10,000 and the Germany entity who was the promoter of real estate receives the 10,000. And this is the beauty of tokenization. It allows cross-border capitalization to go one-to-one, which opens new regions, new approaches, new clients, new investors, just because of this settlement. Kind of like there's no fees. There's potential fees between intermediaries if you use some text or whatnot. But the important thing is, theoretically speaking, one-to-one is possible. Is this the only thing? No, because now there's other opportunities. But before I go and jump into more opportunities, and hopefully one of you throws me a question, I would like to establish something. Okay, I'm giving you kind of the characteristics as to why tokenization is thriving. But the important thing is that we understand now two main aspects in the world. We have public markets and private markets. Private markets are unverifiable, right? We don't know because one entity in its layer privately owns that information and the data and it's not shareable unless there's some mechanisms of sharing, but by default, nobody shares its true value, right? Not even startups unless you read it on the news and say, oh, this company raised a 20 million valuation. That's the first snapshot that you will receive on the valuation of a company. But if you go to the corner restaurant, you don't know how much it's worth unless we go into public markets. NASDAQ, Euronext, Group 6, whatever we want to go for a public market, there's a valuation established. We know what is the valuation of Tesla because it's tradable in a public market. But we don't know of all the competitors that are not tradable in a public market, what is the valuation. So by default, we don't even know what is the electric market. So the electric car market on its globally, on its full scope, right? And why does this matter? Is because we tend to think that offline financial instruments, that means things that we don't know its value because we don't have the connection, the information, the database, access to the ledger, the financials, so everything, it's obscure. So we don't know what is the correct measure. We only can measure what is publicly available. And sometimes real estate is publicly available because there's companies showcasing maybe an estimation on what is the meter square on this street or on Champs-Élysées. Probably, since there's a lot of transactions between purchases and offerings and demands, you can establish what is the meter square, but it's just a theoretically speaking value. We don't know what is the true value. So even those kind of metrics are theoretically speaking. The only real public value that we have are public markets because it's an offer and demand on a daily base, not on a 24/7 daily base, but it's still more open than other markets. So why I'm telling you all of this is because I will say, and this is just an assumption that I'm making up because I don't even know what is the true value. Nobody knows. Let's say that half of everything out there, it's a private market. And every day, new instruments are being built. There's new buildings happening. There's new restaurants popping. There's new companies. So we don't know what is the true value of all the assets in the world. There's new gold mines finding, there's a new Robbie company forming up. We don't know. And let's say that if theoretically, maybe, which I would believe it's way less, half of it is publicly available to public markets. So we don't know how much is offline. We may estimate how much real value we have, and only less than 1% is using blockchain technology. All right. So this is the full of opportunities. And you will say, why would it matter what is blockchain? Because blockchain, for the first time in history, can graph offline value and online value. Blockchain is not the one only grabbing value from a specific sector, so publicly available data. When you tokenize any asset, that means when you represent a financial instrument of anything and you're putting it in a public ledger, you just establish the public valuation of the asset. So when a promoter privately goes to the family offices that he knows to raise capital for deploying in a building, we don't know that transaction. We wouldn't know because the German promoter would not say, hey, I raised this, because we don't know what was the debt contract he was signing with the family offices. But if the same promoter decides to tokenize the debt or the bond that he's issuing to capitalize to raise for the building, then that value becomes publicly available, because when you use blockchain, that transactions become public available, so a real valuation happens. So by default, that closed environment or dark value becomes open and public available, so becomes real value. Third parties can jump in and establish and say like, hey, this guy did that debt, got value at that much, and got transacted with that. Then I can do the same. So a lot of new markets start opening just because it becomes publicly available. So again, we don't know how much locked value it is. We may know how much publicly available value it is through stock markets or other types of markets. But blockchain, when they say it unlocks value, is that by default, through its characteristics of public ledger, now it becomes open and accessible to the whole world. Yeah, Paulo, it is true. You pay the gas fee, but for example, if you were using USDC in base, it's less than a cent. So it's what they say is gasless. So it is true that the transaction of the stable coin can have gas fees, depends on the blockchain. But right now, due to the current innovation, there's a lot of transactions happening that it costs gasless, which is less than a cent. But if you use Ethereum, yeah, you will still pay. But even now, it's I don't know. I did one before and it cost me 18 cents, which is fair. All right. So, questions on this, or can I continue? All right. Okay, guys. Sorry, I'm trying to amass a lot of things on a sprint of 1 hour, because trying to explain tokenization at a speed rate is something that can be a little bit complex. So I'm hoping that I'm not becoming too complicated, and if not, just please stop me, and then we can talk about what makes no sense. All right. So tokenization. Now, if it's an opportunity to unlock value from private and public markets and all of that, who is choosing it and for what is being used? So management fees also get reduced. A lot of asset owners are starting to tokenize their portfolios. For example, the biggest example that we have right now is BlackRock. BlackRock issued Build Fund last year, March of last year, and they created a tokenized portfolio, a money market fund. So who's using it? If the biggest player or the biggest asset owner in the world is already using tokenization, then I can tell you that the big players are already creating some sort of fund on a tokenized version. But not only big players, also local players. Even local funds in many geographic countries, so I was going to say geographic regions, are starting to digitize and tokenize their portfolios. And why? It's the same logic that it happens as to even BlackRock. For him to receive money abroad, he will have to fight the fees, the capitalization fees. Because when you have your limited partners across the globe, there's still a loss on the fees. So you want to reduce the fees, because the more capital you can obtain from your liquidity providers, the more fees you can maintain for yourself, or the more structured your fund can be. All right. So asset owners, it's opening the door to capitalize with other limited partners that they didn't have an access to or they wouldn't play with just because of the fee on the currency or the bank or other fees. So they're becoming more efficient. Also, because these asset owners are used to using ledgers, they have their own financing, their own accounting, and their own settlements, and they have to do a lot. There's a lot of manpower of understanding what is the current state of the portfolio. If you use a public ledger that is available 24/7 with real-time data, then you also optimize a lot of the process internally. You can establish how much money is received from who. You can pay in one single transaction 1 million. It said like the other day, I think Bill did like 300 transactions, 1 million in 3 seconds. Like it becomes way more efficient than going one person sending 300 transactions via a bank to bank, which is doable, but it's a lot of human power. With the efficiency of smart contracts, you can do, and this is kind of like seriously, without a joke, you can transact, you can send 1 trillion euros of USDC if that was available on base network, and probably for 1 trillion euros you will pay like $2. That has never been heard of. And sometimes in the news you can Google, I don't like Bitcoin blockchain, it's too slow, but you see something that's like, oh, these people transacted 20 Bitcoin or 20 million worth Bitcoin and it only cost them $1. It is true. Like if we go to that certainty, if you were to use the bank's entity for sending 20 million, first of all, they will never let you. They will block you. They'll be like, they're not. We can go a lot of conversations between banks, not disrespect to anything. They do the business, but take out 20 million in a single, they will stall you for weeks just because they need to amass liquidity for you to do that transaction. Even if you have 22 million, you would never be able to take out that 20 million in a single transaction. And even if you did it tomorrow, you'd be like, oh, I'm using this opportunity. They will say, oh, I need compliance. I need you to sign this. I need to understand where the 20 million is going. It's like your hard-earned money is protected by another entity. But this is where if you don't use that intermediary and you want to transact to a different level, your 20 million, you send them, you're good to go, and that's it. It doesn't come without risk because blockchain does have some risk. If you send it, you cannot come back. So if you put the address wrong, the money may be lost. So there's some degrees of uncertainty that we're still building to make it more secure. But the important thing is that it's happening, right? So I have nothing against banks. It's just that the efficiency level that the blockchain layer technology is bringing to the financial markets has never been seen of just because it's very simple. It becomes what Bitcoin white paper, if any of you have read it, a P2P banking system directly between two entities, persons or companies. And that is what brings in efficiency. So a lot of asset owners are jumping in here. Real world assets is a common word that we're thinking about, kind of like what is a real world asset? Super simple. Everything that is not on chain, that is real world asset. So USD, when transformed to USDT, becomes a real world asset. It's the digitization or representation on chain. We thought we see in real estate getting tokenized. We can talk about that, but let's pretend that it is, and it's fine. Real estate in its digital format, it's a real world asset transacting on chain. I talk about the example of the German promoter capitalizing via a Colombian entity. It can be done now because the capitalization becomes available worldwide. Commodities, we see gold getting tokenized, diamonds, or other types of even salt. There's been a lot of different tokenizations happening just because of the same reason. And I'm going to put it another way. I don't need capitalization, all right? And let's say I'm a family office that owns a gold mine. Will I tokenize steel? The answer is yes, because let's pretend that I do have shareholders. While I don't need to capitalize myself, I do need to pay dividends on the exploitation of my market because I have different shareholders. And the same problem of receiving happens on the issuance. So I did something that makes sense, but let's go for another one. Let's go for a simple restaurant. And I want to pay dividends to my shareholders. And I'm in Spain, and I have somebody in Vietnam because he decided to move to Vietnam. He's still my shareholder. He's still who should be receiving his dividends because it's fair and it's legal. Now, what happens when I have to send, let's say that year, €2 as dividend? It don't matter. The Vietnamese investor needs to receive his dividend because he invested in my restaurant. So no matter where he is, I have to give him his €2. And this is super, obviously, exaggeration on some matters, but it could very well be applicable to everything. I, as the Spanish entity, will not be able to send him the €2. It's impossible. Like if I go to the bank and decide to send a transaction to a Vietnamese bank, I need a minimum amount. And the minimum amount can try between sometimes 50 or 100 just because they need to make enough commissions for them to send, so you wouldn't even receive $50 on that. So it's impossible for me to pay a dividend out of €2 to my Vietnamese investor. So no problem. It's not only the problem the capitalization; it's also on the distribution of the earnings on dividends, interest, and whatnot. So commodities or assets or any other things also make sense to be tokenized because it's not just the fact that now you can receive worldwide money at any time. Is that when I have to pay back, I can also pay them back what is worth one-to-one without me incurring into having to pay fees. Because in the example of the Vietnam, I will probably have to do a transaction of 52, where 50 is a commission and the two get sent. And I will have to do it because I'm legally obliged to do and pay that dividend to my shareholder. All right. And now it comes to the reasoning. Are banks against it? No, of course not. Banks are not stupid. They are playing this game as well. And that's why they're trying to issue their own stable coins or start playing with their own ledgers. There are a lot of proof of concepts happening between banks for the settlement because SWIFT, it's an intermediary processor of banks. So the only reason why they're trying to do this is what happens if we decide to skip the intermediary between our payment processors and go bank to bank? So they also thinking as a P2P, and that's why they're starting to use technology of blockchain just because it makes sense at the fee level. In fact, if some people in Switzerland, they would use BBA, some settlements that are receiving are having already on chain. They're starting to use the infrastructure, not telling you that they're using it, but just because the settlement layer for them is also more efficient because they reduce fees, they can do it instantaneously across the globe. So some banks at the back are starting to use blockchain infrastructure for settling some payments. And that is happening right now. So even banks are playing this because even though they're losing some market share to a P2P market or other players in the fintech business using crypto or blockchain, they know that this is thriving, right? Okay. Questions? I'm gonna grow. Okay, but if the bank does not have, if the bank doesn't have 20 million liquidity, they will probably come up with some excuses and you wouldn't be able to move it. Like I don't know. I've never had 20 million, guys, so it's not a problem of my life. However, this fast and low way of transferring funds comes with some issues, limited financial crime and fraud. It is true. Not the same as before. There's a lot of tools to help mitigate risk when transacting in blockchain. Now, wallets can be created with some players via email and password. So the question here as the uncertainty of the use of the technology is its user experience. I can tell you that the first time I transacted on chain, which was 2017, if I'm not mistaken, I felt like a hacker. Like I even felt cool. It's like, oh, I'm one of the bad boys now. I'm doing all this coding because it felt like that. It was absolutely ridiculous how extremely hard it seemed for some. Maybe for a developer, it will be like it's the same on my day to day. But for me, which I'm a lawyer, I was nervous. I was sending out. I was buying some crypto at that point with some decentralized. We can go about that. It was very weird. The user experience 8 years later matters. Now, risk and fraud, you always have to comply. Even if you're tokenizing, you still have to comply with anti-money laundering directives. So the use of technology does not alter the process or the business. You still have to comply, and most importantly, it doesn't evade the use or it doesn't evade the application of legislation. So what I like to say here is just because I use blockchain does not mean that I need some new law, but it doesn't mean that I don't have to comply with the previous applicable law. So if you are tokenizing and receiving capital from abroad, you have to make sure that the money is legit and there are processes still in place. You don't switch that just because of the use of technology. Technology does not alter the process. It is the process that needs to be compliant with the legislation at hand. Okay, so low cost has mentioned a cent, but that's because, for example, miners get. Yeah, no, but this is. I'm not gonna go into the economic units of miners because I'm talking more from a theoretical point of view. As you can see, mining cost has reduced and the upgrades on Ethereum has make it more efficient for you to transact on Ethereum. So for the sake of this explanation, I will say that I'm going to stay with base network where it is gasless to transact in USDC. It's an L2 over Ethereum where you don't have to worry about the miner so much because it works in a different system. So yes, Bitcoin, it's a blockchain, Ethereum is a blockchain, and the 1,000 other possibilities that are blockchains are also a possibility. There's new blockchains happening on a daily basis. Yesterday, they were launched too. So everybody's looking for the sendless operation because the sendless operation is what most likely is going to bring the most volume to that blockchain, right? But it's a problem that I'm not going to discuss per se right now. Okay. Okay, so on the next one, not gonna go over here, just radically establishing again that everything has a regulation. Some are now specialized. If we had this conversation 2 years ago, Mika was in the process of, so some other analogic legislations were being applied to, corporate law or securities law or some others, just because there was not a specialized establishing what is a utility, what should be considered, how to issue a utility. So that came with specialization. But the important thing is no matter what you guys do on blockchain or use or not, there is always something applied to. Now, quickly, tokenization companies, super interesting. You can tokenize equity, a company can issue debt. What you're doing is you're doing a lot of digitization to the process itself. So your investors can jump on board into a payment, one transaction, the agreement itself can be signed, you create the asset, you automate the payments. So the whole process of capitalization gets reduced to a couple of clicks. And this is kind of like the evolution of technology. We like to do clicks or 50-second reels. We don't like to do hard work anymore or think. And fortunately for everybody in the capital financial markets, the use of technology, everything can be doable with a couple of clicks. Will that happen on a non-blockchain technological world? No, because the couple of clicks will be stopped by the intermediaries. If you want to sign with the investor, you have to probably sign an agreement that is sent by email, who has to go with the lawyer, and then you have to go before this and then receive the money to the bank. If the investor didn't send the right amount, you have to send the money back and tell them, hey, you made a mistake, you didn't send me all the money. There's a lot of things that happen on a daily basis that slows the whole process. So with full technology on board that is available right now, this all becomes in a couple of clicks, right? Theoretically speaking, let's pretend that there's not a single point of error. There are points of error in the current technology that have to do with the user experience because there are some things that need to get better. The technology is upgrading itself, such as paying to the wrong wallet, to the wrong address, or receiving money without complying with anti-money laundering directives. So there are still a couple of pains of default that need to be managed, but everything is being upgradable as we speak. All right. And one last example, tokenization of companies, intra or supra. Meaning intra, companies are starting to use technology to tokenize their employees, not their employees, their agreements with their employees. So let's say phantom shares or availability of shares. Year, I'm going to give you shares. If you comply with all of that, a lot of these things can now be mitigated via smart contract. So the employee at a certain amount of time can go and claim entirely his portion of shares or whatever it is due. So this is called tokenizing restricted stock units. And it's something that is working right now in other countries, specifically in the UAE region, where they're testing a lot of these things. And it's basically just to be more transparent with your employees. If you tell them that you're going to give them shares in the second year, well, Let's automatize that so the person can go directly to the pool and claim their shares and become whatever you promised them to. Okay, so like I said, capitalization for the outskirts, but also tokenization for the inside. Okay, 1 hour. Yes, did it. Hopefully everybody enjoy it. I can stay a little bit longer because I believe some people will have. I try to condense as much as possible to make it more efficient. There was a lot of ideas flowing around, so hopefully you guys all enjoy it. And yeah, please feel free to ask any question. I'll answer Alex right away. How important is UX and investment in UX? I'm a fan of UX. I'll say that there's not a single innovation that happens without UX. Even ChatGPT, the fact that you chat, perfect UX, and everything we use has to be UX. So no matter if you are in AI, in space, in blockchain, if you don't have UX, you don't have a product. All right.
Okay. So let me just, before wrapping up, we will still have some, I'm sure people have some questions. I have some questions, but let me start by thanking you for this great overview about tokenization. I think you hit the right spot between going too deep or too wide. So it was really good at explaining most of these concepts I had never heard before. So I would say I will open the stage to any questions. If anyone has a question, please raise your hand and we'll go through the order. Otherwise, I have some questions. Well, I guess everyone's clarified about everything. So, well, I have a question. Let's say that I have a stable coin. I don't know how stable coins are regulated at the moment. For example, if living in Europe, if you have a bank account, you're entitled to at least 100,000 euros if something happens to the bank or whatever. So do these stable coins, given that they may not have a regional space in the world, so to speak of, so are they regulated in a specific country, or how does it work?
Yeah, that's a very good question, and it has to do with kind of like how secure is what we're building. The bank, first of all, when you give your money to the bank, you enter into an agreement with the bank, which is called an IOU, because we don't understand that, but we actually are lending our money to the bank. And this is what allows them, when you deposit the money, they can use it for whatever. They have to maintain a balance for you, but that allows them to go into the bank and lend the money to other people or invest in other persons and whatnot. So you are actually lending money to the bank. And this is crucial for understanding, because in that agreement, if you have above 100K and they lose money, since you are in a debt contract with them, they have to replenish up to 100K. So it is due to the agreement factor with the bank that they are repaying you 100K worth, because you lend them way more. But up to 100K, they have to secure and be able to pay you back. But this is between you and agreement with the bank, because obviously the legislators on top say like, hey guys, everybody's lending you money, you cannot just disappear, because it was happening in some countries in Latin America where they were like, oh, I'm closing, and nobody will get money. All right. Now with blockchain technology, you don't have that certainty. With the stable coins, we have seen some stable coin crash, very few. I will go back into the biggest one, the Luna stablecoin crashed 2021, I believe, was it, or 2022? But the bad players are leaving. They might still crash, but right now there's so much liquidity available. And this is one of the most important difference between that stable coin and the legal tender money, is that it is viewable how much stable coin is out there in the market, versus you don't know the bank how much money stores in its treasuries. It's impossible. So you can see how liquid the market is and what is the ratio of default. So sometimes happens with the stable coins that it says that it depegs. since it has to transact with one-to-one, because the asset owner of this or the stablecoin owner has to make sure that in its treasuries it can validate the one-to-one use of its stablecoin on blockchain. That means that no matter how much stablecoins is out there, that person can redeem credits, can liquidate treasuries, can do everything to be able to have the parity one-to-one, right? This is a pure algorithm work. Now, you cannot go to the issuer and claim your money. You can, you could in theoretically go, but you have to go with a lot of credit or treasury bonds or something that the issuer does, because they're not the bank. You here, the stablecoin acts more as if you could go to the central bank for the issuance or redemption of euros. So the central bank is the competitor of the stablecoin provider. The bank will still be a bank. There's banks in Web3. They're not as secure as the Web2 in the sense that you will not get your 100K back. But the stablecoin provider, the competitor, is the central bank issuing legal tender money. Not competitor, but they need each other, right? Another thing about the stablecoin is that even though it's a private company, because this is kind of like what everybody feels are fearful, the central bank is the one issuing money at all times, all right? But we also don't know how much they're issuing or how much they're printing. They say numbers, but we don't know if they're backed or they're not. We don't know, right? There's always saying like they have a printing machine, which is just one button, and we have to take that into consideration. With the stablecoin providers, now with Mika and the future digital asset in US and probably in other countries where they're going to come, they need to be audited. And that's a big game changer for the stablecoin market, because no longer can I say that I have 100 million of stable coins that I can back. Now I have to prove that it can be backed. And such is the case that, for example, Circle did an IPO, I think last week. So USDC owner or creator just went and did an initial public offering in NASDAQ. They get their audit accounts, because you cannot do an IPO without an audit. So that means they did the whole bureaucracy to do an IPO. But also, they were the first company to be licensed in the European Union to use their stablecoin for EU residents. So they've been double audited. Does that give you enough trust as a central bank authority? Well, that is up to the issue to everybody. For me, I'd rather have a private company use the money, because I know they want to generate money and I know the feeling of a company and I understand where they go, than a central bank authority not knowing what angle are they playing per se. All right, because I'm a capitalist. I'm not saying it's right or wrong, but I'm just saying I feel more secure with a private company at least being audited and playing the game that I'm playing as a company, than a central bank printing money for whoever knows what. Like, I don't know where is that money truly going, or what are the indicators of how much or why do we have so much inflation. So it's a matter of perspective.
You're
Oh, you're
muted.
mute.
No.
And sorry for being talking to the hyperspace. Well, I was saying that we are a little bit ahead after the schedule, so 3 minutes late, but I think we still have time for at least 1 or 2 questions.
Sure.
Paul, I think you have a question. At least you have your raise.
Yeah, it's going to be short because I think Edwin will address it quickly. So thank you very much for your presentation. It was very enjoyable for me. My question is something about you didn't say, which is we're talking about tokenization of value, stable coins, and always let's say geared towards the financial markets. But I'm more of a IoT guy, and one
Okay.
of the things that have been it's a trend we are seeing is the tokenization of physical assets through digital twins, for instance. And
I think
yeah, and one of the things that we see is this let's say translation between the value of the physical assets and the value of the digital twin represented in a token. And in your perspective, how do you see this evolution for the future of these physical digital assets being converted into tokens? Do you
Yes.
have some
So
perspective on this? Because I know that this is not well your topic. Okay, I'm a little bit off topic, but
no, it's fine. It's a very good question because here you have established is one of the biggest pain points that we have, and it's you have an online created asset that has to represent a physical asset. So there might be a divergence on the value, and this is something that we have been all the industry itself working to remain the parity, because you can have a real world asset that got burned, but it's still the transaction on the chain. They don't know that it got burned. So it's something that we have to. I'm talking about the real estate here. Just because to make it simple. So you have a tokenized real estate that the value at least is the same, but then today it gets burned, and the owner doesn't say anything, and probably all the investors don't know because it's probably somewhere that is not nobody's near it, that area. What happens there? There's a lot of theoretically approaches and product wise, but to be honest with you, that is something that we haven't yet fully solved because you still fall on the trust of the issuer. But the same situation happens without technology. If you invested in my house and I burn my house and I don't tell you, I don't need to tell you because I'm a cheater online or offline. The problem with online is that suddenly a market could have been created on that situation. So we need to understand how that is measured or how that affects online, because now online it becomes transactable and open to third parties. So it becomes a public market itself. So that's a very hard question for me to answer because it's something that we are still developing. We still fall on the full trust of the asset owner to come and say, hey, my building got burned. We need to do something, because even if it gets burned, maybe the insurance company comes and rebuilds it, so the value is not zero. There's a lot of tangibles here that we don't know how to digitize. Now, that happens with offline assets. The situation happens that it is going to get better when we're talking with machine economy, which is the PIN, which is kind of like really because now the machine can be online, so the data fully gets online and the information on real time gets updated, or with assets that are created fully on chain natively. So in the future, kind of, I'm not a fan of the metaverse, just putting a huge example. All metaverse assets, they will have real-time value at all times just because they were created online. AI, I strongly believe the future of currencies between AI has to be crypto just because they natively can interact, but the information between them can be available online 24/7. The problem is with the duality world that we live in right now, which is the offline asset, the value, the trust, the information, it still needs to be uploaded online. And the uploaded mechanism is something that is being built. There's a couple of applications, but nothing that tells me right now with 100% that I can give you a true, honest question and say, like, it's solved, there's not a problem. There is a problem.
thank you very much.
Good question. Thank you.
Once again, let me thank Edwin for taking this invitation and talking us or explaining us how tokenization works. I hope you have enjoyed the session. I have linked a little survey on the chat if you wish an attendance certificate. It takes 2 minutes to answer it. It's quite rather quick. I would like to make an announcement. We will be having an event on July 8th. It has been temporarily suspended. We don't know if our guest speaker is going to be able to attend or not because he has got the virus and he's still recovering. So if we can manage it, it depends on his well-being. And we're still trying to, we have a speaker for July 10th. We don't have the topic yet, but we're waiting for it to be able to start the advertisement for it. So once again, thank you for coming to this session and hope to see you on the next ones. And Edwin, we are much appreciated for you to take 1 hour of your precious time and be able to explain us how this works. So once again,
Thank you. Thank you very much for the invite. See you next time.
see you.
Thank you. Bye bye.